Sydney house prices just had their worst month in 3.5 years. CoreLogic numbers released at the end of June show Sydney home values dropped 1.2% in a single month. Over the past quarter, they're down 3.2%. And since the market peaked back in November last year, Sydney has now given back around $28,000 off the median home value. If you own a home in Sydney or you've been waiting years to buy one, you've probably felt this shift already, even if you couldn't put a number on it. So today, I want to walk you through what's actually happening, why it's happening, and why I think this isn't a crash, it's a market that's going to sit flat for a while. Probably until 2028, when a couple of big infrastructure projects out west actually get finished. Before I get into it, if you're someone who's trying to buy, sell, or just keep tabs on Sydney property, this channel breaks this stuff down every week using the actual data, not guesswork. So if that's useful to you, hit subscribe now so you don't miss the next one. Alright, let's get into what's going on.
Let's start with the basics, because a lot of people hear prices fell and assume the market's collapsing. It's not that simple. Back in 2025, the Reserve Bank cut interest rates a few times, which made borrowing cheaper, which pushed buyers back into the market. Sydney prices took off, and by November 2025, they hit a record high. Then this year, the Reserve Bank reversed course. They raised the cash rate 3 separate times in February, March and May, taking it up to 4.35%. That undid basically all of last year's rate cuts. At their June meeting, they held it steady at 4.35%, which was expected, but it wasn't good news either. The message from the bank was that inflation's still too sticky for them to start cutting again anytime soon. Most economists now don't expect a rate cut until sometime in 2027. Higher rates mean higher mortgage repayments, which means people can borrow less than they could a year ago. And when buyers can borrow less, they simply can't pay as much for a house. That's the whole story behind why prices have turned down.
Here's where things stand right now in plain terms. The median house value in Sydney sits at $1,282,020. That's the middle point. Half of Sydney homes are worth more, half are worth less. It's down about 2.1% from the November peak. Auction clearance rates, that's the percentage of homes that actually sell on auction day, dropped to 47.4% in late June. That's the first time it's fallen below 50% since the early days of COVID. In plain English, more than half the homes going to auction right now aren't selling on the day. Sales volumes in Sydney are down 17% compared to a year ago. Listings, on the other hand, are up, so you've got more homes for sale and fewer people buying them. That combination is exactly what pushes prices down or keeps them flat. And here's a number that actually explains why this hurts even though prices are falling. Since those 3 rate hikes, the average income earner has lost around $36,000 of borrowing power. For a couple buying together, that's closer to $72,000. So even with prices coming off their peak, plenty of buyers are worse off than they were in January because what the bank will lend them has shrunk faster than the price has.
Now here's the part that actually explains the 2028 timeline, and it's mostly about what's happening in the west of the city. The new Western Sydney International Airport at Badgerys Creek is set to open in October this year. That part's basically locked in. But the metro train line that's meant to connect St Mary's to the airport, running through Orchard Hills, Luddenham, the new Aerotopolis precinct and Bradfield, has already slipped once, from late 2026 to December 2027. And Sydney Metro's own project documents have flagged what they call an elevated risk that it slips again, possibly into 2028. Part of the hold-up has been a dispute with the builder over roughly $2.2 billion in claims, which got serious enough earlier this year that construction actually slowed down while the two sides negotiated. Why does a train line matter this much for house prices? Because right now the airport is basically an island. Without the metro, it's hard for workers to get there, which limits how many jobs actually show up in the surrounding suburbs. Once that line is running, suburbs like St Mary's, Orchard Hills, Leppington and Penrith suddenly become genuinely commutable to a major new employment hub, and that's usually when you see the next wave of price growth in a corridor like this. We've already seen a preview of it. Bringelly, right next to the airport site, has gone from a median of around $935,000 to $2.4 million, as early buyers priced in the airport before it even opened. But agents say buyers further out are more cautious because the full benefit doesn't land until that metro line is actually carrying passengers. Worth mentioning too, Sydney Metro West, the bigger line connecting Parramatta to the CBD, is a separate project, and it's not due until 2032, so that one's a longer story. The nearer-term flatline I'm talking about is really about the airport corridor and interest rates, not the CBD to Parramatta line.
Put it together, and you get a market that's stuck between two forces. On one side, higher rates and a federal budget that's proposing changes to negative gearing and capital gains tax are squeezing both buyers and investors. On the other side, the infrastructure that would justify the next leg of price growth in the West isn't finished yet. That's a recipe for sideways, not a crash and not a boom. On top of that, buyer confidence backs this up. The survey that tracks whether people think it's a good time to buy a home is sitting at its lowest point in the current cycle, well below its long-term average. The big four banks don't even agree on the direction from here. CVA is calling for prices up 2% this year. ANZ says down 0.7%. Westpac's the outlier at -3%. When the banks themselves are that split, it's usually a sign the market genuinely doesn't have a clear direction yet, and that's consistent with a flat line, not a crash.
So if you're waiting for Sydney prices to fall off a cliff, the data right now doesn't support that. And if you're expecting another boom like late 2025, the rate settings say otherwise too. The real turning point is out west, tied to a train line that keeps getting pushed back. Until that line is running or the Reserve Bank starts cutting rates again, Sydney is probably not going nowhere fast. If this kind of breakdown is useful to you, subscribe for the next one and drop a comment with the suburb you're watching. I'll pull the numbers on it.